Welcome to a new deep dive, where we cut through the noise and get straight to the essential insights. Today, we're taking a close look at UMC's second quarter 2025 earnings call. That was on July 30th. Our mission, like always, is to really pull out the most important nuggets of knowledge, giving you a shortcut to being well-informed. Given how the market reacted initially, we're coming into this with, let's say, a cautiously constructive tone. We'll highlight the wins that got people excited, but also, the challenges that maybe cooled things down a bit. Okay, let's unpack this, kicking things off with the headline numbers. UMC delivered a clear revenue beat. They came in at $2.01 billion. That was what, $0.09 billion above consensus estimates?
Yeah, 9 cents above. And it marks a pretty healthy 3.5% year-over-year increase. So solid top line.
A strong top line performance, definitely. But, well, as always, there's more to the story, isn't there?
There usually is. And what's fascinating here, I think, is that while revenue clearly outperformed, the GAAP earnings per share, the EPS, it actually missed consensus. They reported $2.12 against an expected $0.14. So that immediately signals, a more nuanced story beyond just that top line growth. Tells us that while they brought in more money than expected, something on the cost side, maybe financial structure, hit their profitability.
And it certainly does point to that kind of complexity. We also saw gross margins come in at 28.7%. Now, that's a pretty significant drop, 650 basis points year over year.
Yeah, 6.5 percentage points lower than last year. That's quite a dip.
It is. And their operating margin came in at 18.4%. On a more positive note, though, capacity utilization saw a healthy improvement, climbed to 76% in Q2.
Right, up from 69% in the prior quarter. So factories are definitely getting busier.
Which is generally a good sign.
Absolutely. And if we connect this to the bigger picture, management they were very clear in emphasizing the EPS miss. They basically said it was primarily currency, not pricing related.
The currency factor, the strong new Taiwan dollar.
Exactly. The NT dollar had a really substantial impact.
Yeah.
I mean, think about it. UMC's costs, like labor, local operations, they're mostly in NT dollars, right?
Right.
But they sell their wafers globally, mostly in US dollars.
Right. So when the NT dollar gets stronger,
every US dollar they earn buys fewer NT dollars to cover those expenses. It effectively bumps up their operational costs in USD terms. And that just erodes their gross margin. They even quantified it, said it knocked off about 3 percentage points from gross margin in Q2 alone.
Wow, 3 points just from FX. That's a massive headwind.
Huge headwind they're battling.
Okay, but here's where it gets, for me, really interesting. Despite that currency drag, they specifically noted that their USD average selling prices, their ASPs, stayed firm.
That's the critical point, isn't it?
It really is. It signals confidence that utilization has, in fact, bottomed out, and maybe more importantly, that they're not having to just slash prices to fill their fabs.
Right. That stability in ASPs, even with the currency pressure, it suggests a healthier demand environment for their stuff than maybe that headline EPS miss would suggest on its own.
Exactly. So, okay, demand seems okay, pricing stable, but margins hit by currency. What about the underlying cost structure? Depreciation, things like that.
Yeah, good question. And they actually provided some really crucial long-term clarity there. Their annual depreciation growth, essentially the cost of all that expensive equipment being spread out over time, that's projected to peak around 2025.
Peak in 2025. Okay.
And after that, the magnitude of those depreciation increases is expected to significantly decline.
Yeah.
They're talking potentially dropping below 10% growth in 2026 and 2027.
So that drag on gross margins starts to ease off.
Precisely. It's like, paying off the biggest chunk of a massive loan. It frees up more cash flow eventually, helps expand margins down the line. And despite the currency drag and that high depreciation now, they still maintained a pretty healthy operating margin of 18.4%. Plus, they generated a robust NT $10.2 billion in free cash flow. That points to some real underlying operational strength, I think.
That solid cash flow is key. And it brings us to a specific area of real strength that probably supports that stability, their differentiated technology. A standout metric for the quarter was the record contribution from their 22 nanometer and 28 nanometer nodes.
Yes, the 22 and 28 nanometer performance.
These aren't just specs, right? These are their specialized, higher value process technologies, and they now account for a robust 40% of total revenue.
40%. That's a really significant chunk. And it shows strong execution in those differentiated offerings. It also shows customers are actively buying into these solutions, moving UMC, further away from being just a commoditized foundry player.
So these aren't the standard low-margin chips we sometimes think about.
Not at all. We're talking specialized applications. Things like high-end smartphones, OLED displays, specific IoT stuff, automotive components where power efficiency or unique features are really key. This whole strategic shift towards these higher value nodes helps insulate them somewhat from that brutal price competition you see in the more commoditized segments.
So they're carving out a higher value niche.
Exactly. And that 40% number, it's concrete proof that their long-term bet on specialized tech is, well, it's fundamentally reshaping their revenue quality.
Okay, so with those strong points in mind, let's look ahead. What did management actually guide for Q3?
Right, the outlook. For the third quarter...
Okay, modest growth there.
Yeah, and USD ASPs projected to remain flat, which reinforces that pricing stability story we were just talking about.
Good, and margins?
Gross margins are guided to stay around the Q2 level, but of course that's subject to foreign exchange fluctuations as always.
Naturally. And utilization?
Capacity utilization is anticipated to remain in the mid-70% range. So pretty stable, holding steady with their current operational rhythm.
Okay. Now, their strategic moves seem quite significant, especially thinking longer term about capacity. The Phase 3 expansion of their Singapore Fab 12i, that's set to begin production January 2026.
That's the plan.
Yeah.
January 2026 start, with higher volume ramping up in the second half of that year.
And that's a key part of their supply chain diversification, right?
Yeah.
Why is that so crucial right now?
Oh, it's incredibly important. In today's world, with all the geopolitical stuff and potential disruptions, relying too heavily on one single region, that's a big risk for any semiconductor company.
Makes sense.
So UMC is actively expanding its manufacturing footprint. Singapore is a prime example, and also broadening its customer base. It just makes their business more resilient against trade issues, regional slowdowns, even, natural disasters. It's really about future-proofing their operations and ensuring they can supply global customers who are also looking for that supply chain resilience.
That strategic foresight, it brings us to another major partnership they have, the Intel collaboration on 12 nanometer. Any updates there?
Indeed, they gave some updates. Management confirmed the partnership is progressing well, still firmly on track.
Good to hear.
They expect to deliver an early process design kit, the PDK, basically the toolkit chip designers need for the first wave of customers by June 2026.
Okay, June 26 for the PDK.
Then customer product tapeouts, that's the final design ready for manufacturing, should start sometime in 2027.
And revenue follows that.
Revenue contribution should start around that 2027 timeframe, yeah. And this isn't just some small technical thing. It's expected to play a really material role in their medium-term gross margin outlook, specifically in absolute dollar terms. So potentially a high-value stream.
Interesting. So beyond just capacity and big partnerships, UMC isn't standing still on the innovation front either. They're developing advanced packaging solutions. Why is that becoming so critical?
Yeah, advanced packaging is huge right now, because traditional chip scaling Moore's law is slowing down, right?
Yeah.
So advanced packaging is how companies are squeezing more performance and efficiency out of chips. It's the next frontier in many ways.
Okay, so what are they doing specifically?
Well, UMC is focusing on it particularly for the growing energy demands in cloud AI, and also the potential boom in edge AI applications.
Yeah.
They're developing things like 2.5D interposers. Think of those as little bridges connecting multiple chips side by side for faster communication.
Right.
And they're also leveraging scalable 3D wafer-to-wafer stacking and through silicon via or TSV technology.
Okay, breaking that down.
In simpler terms, they're building the vertical highways and multi-story buildings for chips. Stacking them up allows for vastly more powerful and energy-efficient designs. This is really crucial for next-gen stuff like 5G, 6G, RFICs. And they're even looking at memory-to-memory and memory-to-logic stacking for the kind of high-bandwidth computation needed in, the most demanding AI systems today.
That's a serious investment in the future of chip design. Okay, so let's switch back to the call itself. How did the market initially react to all this information?
Well, the immediate reaction was somewhat mixed, kind of reflected the nuanced results we've been talking about.
A bit of a split reaction.
Yeah. The stock initially popped a bit. I think there was some relief from the revenue beat and that stable shipment guide for Q3. Maybe expectations were lower.
So relief rally first.
Right. But that enthusiasm got tempered pretty quickly by the EPS miss and those lingering concerns about the margin ceiling, especially given that big year-over-year drop in gross margin.
Understandable.
So overall, the sentiment seemed to remain cautiously constructive, acknowledging the good stuff, the underlying trends, but still wary of those new-term profitability headwinds, mainly the currency.
Gotcha. So stepping back, what does this signal for the broader semiconductor industry? Did UMC offer any perspectives on market dynamics?
They did. They noted that foundry inventory digestion seems to be nearing its end.
That's potentially good news, right? Means customers are working through stockpiles.
Exactly. New orders should start reflecting true demand more closely, not just refilling empty shelves. And demand for advanced nodes, especially the ones UMC specializes in, apparently remains firm.
But challenges remain.
Oh, definitely. They're navigating significant macro and geopolitical headwinds. That includes the ongoing foreign exchange volatility we keep mentioning, and also the U.S.-China tech controls, which just create uncertainty around supply chains and market access for everyone.
And wasn't there something interesting about customer behavior related to those external factors?
Yes, absolutely. The company observed some demand upside in Q2 and Q3 that was partly driven by customers building up inventory specifically in anticipation of potential U.S. tariffs.
So tariff front-running, essentially.
Kind of looks like it. It suggests that the usual seasonal patterns in the industry might be getting skewed by these external policy factors, creates these demand spikes that aren't necessarily purely organic growth.
A reminder of how interconnected everything is. Now, looking at inventory levels more broadly across segments.
UMC indicated they're currently quite healthy in consumer and communications. That's a positive sign for underlying demand there.
But not everywhere.
No, they acknowledged inventory is still elevated in automotive and industrial segments, suggests maybe a slower recovery in those areas.
Okay. And despite maybe lower visibility for Q4, their full-year outlook
remains unchanged for 2025. They still expect to outgrow their addressable market, which they see growing low single digits. That's actually a fairly confident statement given the environment.
It is. So for the long-term goal of getting those gross margins back up, what's the strategy?
It's multifaceted, really. First, improving loading, basically, getting factory utilization consistently above that mid-70s level.
Yeah.
Second, continued technology differentiation with those advanced nodes we talked about. And third, just deeper customer engagement, building stronger partnerships.
And all that combined with the depreciation easing off after 2025.
Exactly. That combination forms their roadmap back to what they called a reasonable margin level. It's clearly a patient, deliberate strategy, not looking for a quick fix overnight.
Makes sense. And competitively, they seem to be really leaning into that specialty foundry niche.
Doubling down on it. Over half their revenue now comes from those differentiated technologies. The 2228 millimeters for high-end phones, OLEDs, the 22 nanometer ultra-low leakage stuff for IoT.
Yeah.
The whole strategy is to keep increasing the revenue contribution from these specialized areas. That helps reduce direct competition with other foundries, especially those just focused on mature, high-volume processes.
Less head-to-head fighting.
Right. And they gave an example. Their China-based 12X facility is apparently already running at full capacity, serving diverse customer needs there. Shows they can execute this specialty strategy globally.
Okay, let's shift gears now. We've unpacked the numbers, the strategy, the context. Let's flex those analytical muscles a bit. Time for our This Is Not Financial Advices segment, where we pitch a kind of outrageous but plausible trade idea, like we're analysts talking to an investment committee.
And remember, folks, this is purely for entertainment and discussion. Just getting you thinking critically about how you might interpret these calls. Don't run out and do this.
Definitely not financial advice. Okay, my idea for UMC coming out of this call, a tactical long-term relative value, like UMC's stock has significantly underperformed the SOXX index, right? That's the main semiconductor benchmark.
Yeah.
UMC's down like 14% over the past year, while the SOXX is up maybe 32%. Big gap.
Huge performance gap, yeah.
But this earnings call, I think, reveals a solid strategic pivot and, crucially, a clearing path for future margin expansion, even if it's not immediate.
Okay, so what's the core thesis? How do you bridge that gap?
The thesis is this. Yeah, near-term gross margins are definitely constrained by the strong NT dollar and those high depreciation expenses, no doubt. But management's newfound clarity on depreciation peaking after 2025, that's a potential game changer for the medium term. Combine that with the undeniable success they're having ramping their differentiated 2228 millimeter nodes, now 40% of revenue, remember, and they're deepening Intel collaboration on 12 millimeters. Well, you have a pretty compelling long-term story brewing, I think.
So the trade itself.
My hypothetical trade. Go long UMC, maybe the ADRs, and simultaneously go short a basket of more commoditized, less differentiated legacy foundry players.
So shorting the ones more exposed to just pure capacity swings and price wars.
Exactly. The ones without UNC's level of tech differentiation or major strategic partnerships like the Intel one, this isn't just betting on UMC turning itself around individually. It's a bet on the increasing value of their specialized tech and partnerships within this volatile macro environment. The idea is they can meaningfully close that performance gap with the broader SOXX index over, say, the next 12 to 18 months.
So it's a contrarian bet, really.
Yeah.
Exploiting the current market pessimism on margins.
Right. A contrarian bet on this currency capped now, but margin recovery later narrative. You're betting on their long-term strategic execution and maybe getting a kicker if the NT dollar eventually softens a bit.
Interesting angle. Definitely plausible, definitely not advice.
Okay, so let's quickly recap this whole deep dive then. UMC delivered a revenue beat that was driven mainly by strong demand in key segments and that record performance from their differentiated 2228 nanometer nodes.
Right. But earnings per share missed. Management pins that primarily on the foreign exchange headwinds the strong NT dollar. So a currency story, crucially, not a pricing pressure issue.
Looking ahead, their big strategic investments, the Singapore Fab 12i expansion, the deepening Intel collaboration, they seem to position UMC for future growth, even as they keep navigating these ongoing macro and geopolitical uncertainties.
Which really raises an important question for you, the listener, to think about. What does it mean for your portfolio when a company's underlying execution looks pretty solid? But currency swings are the main headwind right now, and these significant long-term strategic investments are really just beginning to mature.
Yeah, how do you weigh that near-term FX pressure against what seems like a clear, albeit maybe gradual path for future margin recovery? Something to ponder. And just one last time, this discussion is purely for informational purposes. It is absolutely not financial advice. We're just here to help you get informed quickly and thoroughly. We really hope you found this breakdown valuable. What stood out to you in this deep dive? We'd genuinely love to hear your thoughts.
Yeah, thank you for joining us for this deep dive.
And we look forward to our next one.